800 vessels sat idle in the Persian Gulf on Monday morning. 400 of them were oil tankers. None were moving. The tanker Rich Starry had been loaded with Iranian crude and bound for China. Then it made a U-turn and joined the stationary fleet. That moment was the clearest signal yet that the U.S. blockade of the Strait of Hormuz had begun in earnest. President Trump announced the move after weekend ceasefire talks between the U.S. and Iran collapsed without a deal, though back-channel communication reportedly continues. The blockade covers the narrow waterway through roughly 20% of the world's oil and liquefied natural gas normally flows. Brent crude crossed $104 intraday Monday before settling near $99. That is still more than 40% above the roughly $70 level that prevailed before the war began in late February. Iran threatened that no Gulf port would be safe if the blockade held, and called the U.S. action piracy. The mechanism here is not complicated. Oil forecaster Dan Pickering, who founded Pickering Energy Partners, put it plainly. Roughly 5 million barrels per day of demand destruction is coming over the next few months if the strait stays closed. That destruction happens not because the world stops wanting oil, but because the oil physically cannot get through. Asian nations have already begun emergency conservation measures. Ireland cut fuel taxes to reopen a domestic refinery as farmers and truckers protested rising costs. Zambia warned of a $100 million hit to its economy. The inflation channel opened immediately. U.S. March CPI came in at 3.3% year-over-year, driven by energy prices. Polymarket bettors, who had been pricing in at least one Federal Reserve rate cut before summer, sharply reversed that bet. Wall Street's consensus shifted toward no cuts in 2026, with some analysts flagging that the Fed may instead face pressure to hike if gasoline keeps climbing. The contradiction the market is now trying to hold together is this. Oil is above $100 because talks failed, but stocks recovered to their pre-war level because Trump said from outside the Oval Office that the U.S. had been called by the other side. That fragile hope that back-channel contact exists was enough to pull the S&P 500 up 1% on Monday, reclaiming all losses since the war began, but the oil market's behavior reveals the weight of doubt underneath.
Goldman Sachs reported $5.63 billion in profit for the first quarter, more than analysts had expected, with earnings per share of $17.55 against a consensus estimate of $16.49. On paper, that is a beat. In practice, the stock fell 1.9%. The reason sits in the fixed income, currencies, and commodities division. Revenue there fell 10% to $4.01 billion, dragged down by slower interest rate trading, mortgages, and credit products. RBC Capital Markets analyst Gerard Cassidy called the FICC disappointment the central driver of the stock's decline. A bank that is supposed to profit from volatility ran into a specific kind of volatility, the kind driven by geopolitical shock, that suppressed trading in the instruments it relies on most. Everything else worked. Investment banking revenue jumped 48% to $2.84 billion. Goldman advised on Unilever's planned $65 billion food business merger with McCormick, and on Equitable's $22 billion tie-up with Corebridge. Global M&A volumes hit $1.38 trillion in the first quarter, and Goldman led market share in proxy fees. Equities trading had a record quarter, with revenue up 27% to $5.33 billion, as clients scrambled to hedge war-driven downside risk. CEO David Solomon said the environment for investment banking activity remains incredibly robust, particularly in M&A, and that IPO activity will rebound once conditions stabilize. Goldman is reportedly one of the lead banks on the SpaceX IPO expected in June, which could value Elon Musk's company at $1.75 trillion. OpenAI and Anthropic are also in the IPO queue for later this year. What Goldman's quarter does is set a template for the rest of bank earnings week. JPMorgan Chase, Wells Fargo, Citigroup, Bank of America, and Morgan Stanley all report within days. If the pattern holds, strong deal-making, strong equities trading, soft FICC, the conclusion Morgan Stanley strategists have already drawn looks more likely. Earnings are shielding the S&P 500 from the full weight of the Iran war. That shield held Monday. But the FICC crack is worth watching as a leading indicator. It reflects what happens to trading revenue when uncertainty is so extreme that even institutional players freeze. If ceasefire talks stay alive, FICC could normalize fast. If the blockade holds through the second quarter, that $4 billion FICC number could slide further, and the earnings shield begins to thin.
An internal memo from OpenAI's chief revenue officer, sent to staff on Sunday, confirmed what months of reporting had suggested. The company's partnership with Microsoft had been limiting its ability to serve enterprise customers. Our Microsoft partnership has been foundational to our success, Denise Dresser wrote. But it has also limited our ability to meet enterprises where they are. For many, that's Bedrock. Bedrock is Amazon Web Services' platform for deploying third-party AI models.
Since OpenAI's Amazon partnership was announced in late February, Dresser said customer demand had been frankly staggering. The numbers behind the Amazon deal are significant. Amazon plans to invest up to $50 billion in OpenAI as part of the strategic partnership. An existing AWS cloud contract was extended by $100 billion over 8 years. OpenAI also agreed to use 2 gigawatts of power through AWS infrastructure running on Trainium, Amazon's proprietary AI chip. Under the prior arrangement, Microsoft retained a right and first refusal over compute, a clause that constrained OpenAI from co-developing products with cloud rivals. That constraint has been renegotiated. The revised agreement, reached in October 2025, gave OpenAI the ability to work alongside third parties. Microsoft retains stateless API traffic and sole licensing rights to OpenAI's underlying IP, a meaningful position, but the exclusive grip on enterprise cloud deployment is gone. The immediate market consequence runs through Intel. Elon Musk's Terafab project, which draws on Tesla, SpaceX, and xAI for its chip demand, brought Intel's foundry business into the center of the AI infrastructure buildout. Intel separately secured a deep AI partnership with Google, integrating Xeon processors and custom infrastructure processing units into Google Cloud. Those 2 deals, Terafab and Google, drove a 9-day winning streak for Intel stock and a 220% rally from its lows last August. Intel has also secured $8.9 billion in U.S. government funding under the CHIPS Act. The structure that emerges is this: OpenAI's defection from Microsoft exclusivity, combined with Terafab announcement and Google's Intel bet, signals that the AI infrastructure market is no longer a 2-player race between Microsoft Azure and Google Cloud. It is fragmenting into specialized compute, custom silicon, and purpose-built data centers. The companies that build the physical layer of that fragmentation, Intel, Amazon Web Services, Oracle, may benefit more durably than the model providers competing above them. The verification point arrives on April 23rd, when Intel reports earnings. If revenue guidance from the foundry segment confirms Terafab and Google ramp up, the 220% rally finds fundamental support. If execution lags, as some analysts at Wells Fargo and Cantor Fitzgerald have cautioned, the stock's valuation premium compresses quickly. The weight of evidence points toward continued AI infrastructure buildout even amid geopolitical pressure. Energy costs from oil-driven inflation create real headwinds for data center operators. The Iran war is already straining California's power grid. If the blockade holds and energy prices stay elevated, hyperscaler capital expenditure could slow in the second half of 2026. That would be the condition under which this entire infrastructure thesis stalls. The counterargument that AI demand is inelastic enough to survive $100 oil has not yet been tested at this price level.